Listen, I need to talk to you about something that's costing people thousands of dollars every single year, and most don't even realize it's happening. Whether you're just starting your investment journey or you've been at this for decades, this conversation matters. We're in a financial environment that's changing the rules of the game, and if you're sitting on large amounts of cash thinking you're playing it safe, you might want to reconsider that strategy. Before we dive in, if you find this helpful, hit that subscribe button. The content on this channel is designed to give you practical strategies and real information about building wealth. And drop a comment below. I'm genuinely curious. What percentage of your portfolio is in cash right now? No judgment. I just want to understand where you're starting from. Let's talk about cash and what it really means. Here's something many people don't fully grasp. Cash loses purchasing power over time, especially during periods of inflation. You might see $100,000 in your savings account and think you're secure. And look, having savings is absolutely important. But if that money is earning 3% interest while inflation runs at 5%, you're actually losing 2% of purchasing power every year. Let me put real numbers to this. If you have $100,000 sitting in cash and inflation averages 5%, in terms of what you can actually buy, you're losing about $5,000 annually in purchasing power. Your account balance stays the same, but your groceries cost more, gas costs more, housing costs more. That's the invisible tax of inflation. Now, I can already hear some of you thinking, Robert, what about market volatility? What about crashes? Shouldn't I have cash ready for opportunities? And that's a completely valid question. Yes, you absolutely need liquidity. Every smart investor has cash available, but there's a meaningful difference between strategic cash reserves and holding excessive amounts that aren't working for you. Most financial advisors suggest keeping 3 to 6 months of expenses in readily available cash for emergencies, maybe more if that helps you sleep better at night. But beyond that emergency fund, you want to consider putting your money to work. Here's what wealthy people understand. They don't hoard cash. They hold assets, assets that generate income, assets that have the potential to appreciate: real estate, dividend-paying stocks, bonds, index funds, businesses. These are the vehicles that build wealth over time. Cash is the fuel, but you need to put it in the right vehicle. Think about what's happened with monetary policy recently. Central banks have printed unprecedented amounts of money. When you increase the money supply dramatically, each individual dollar becomes less valuable. It's basic supply and demand. So what should you actually consider doing? Let me give you some concrete strategies. 1. Dividend-paying stocks. This is a cornerstone strategy for generating passive income. When you own shares in established, profitable companies that pay dividends, you're essentially getting paid just for holding the investment. I'm not talking about speculative companies. I'm talking about stable businesses, utilities, consumer staples, healthcare companies, financial institutions, companies that have been paying and increasing dividends for 25, 30, even 50 plus years. These dividend aristocrats typically yield 3 to 4%, but here's what makes them powerful. That's just the dividend yield. The stock price often appreciates too. Over time, you're looking at potential total returns of 8 to 12% annually, though past performance doesn't guarantee future results. Compare that to cash earning 3% while inflation runs at 5%. The math starts to make sense. Compare that to cash earning 3% while inflation runs at 5%. The math starts to make sense. 2. Bonds for stability. I know bonds sound boring, But after years of low rates, we've seen rates increase significantly. Now you can lock in yields of 5 to 7% on quality corporate and government bonds. Bonds provide predictable income and have maturity dates. You know when you're getting your principal back. They add stability to a portfolio when stock markets get choppy. One strategy I use is bond laddering, buying bonds with different maturity dates spread across several years. This way, you're always having bonds mature that you can reinvest at current rates, whether rates go up or down. 3. Real estate exposure. Real estate has historically been one of the most reliable wealth-building tools. If you can buy rental property, that's fantastic. If not, real estate investment trusts, REITs, let you invest in income-producing real estate without being a landlord. REITs are required to pay out 90% of taxable income as dividends, which means yields often in the 4 to 7% range. Plus, real estate and rents tend to keep pace with inflation, giving you built-in protection. Now, here's the important part about risk. Some of you are thinking, Robert, what if I invest and the market crashes right after? That's why diversification matters. You don't put everything in one basket. A balanced portfolio might be 50% stocks, 30% bonds, 20% real estate, or whatever allocation fits your specific situation, age, and risk tolerance. When you diversify properly, you're building resilience. If stocks drop, your bonds help cushion the impact. If interest rates shift, different parts of your portfolio respond differently. You're not trying to predict the future. You're preparing for multiple scenarios. Now, here's the important part about risk. Some of you are thinking, Robert, what if I invest and the market crashes right after? That's why diversification matters. You don't put everything in one basket. A balanced portfolio might be 50% stocks, 30% bonds, 20% real estate, or whatever allocation fits your specific situation, age, and risk tolerance. When you diversify properly, you're building resilience. If stocks drop, your bonds help cushion the impact. If interest rates shift, different parts of your portfolio respond differently. You're not trying to predict the future. You're preparing for multiple scenarios. Let me share a story that illustrates this. Years ago, I knew an investor with $3 million in cash. He was waiting for the perfect opportunity, specifically waiting for a market crash to buy stocks at a discount. Look at your current situation. If you're holding significantly more cash than you need for emergencies, ask yourself why. Is it fear? Is it uncertainty? Is it just inertia? Those are understandable feelings, but they shouldn't drive your financial decisions. You don't have to do everything at once. Start small if you need to. Take 10-20% of your excess cash and put it to work. Buy some dividend-paying stocks through a low-cost index fund. Invest in a bond fund. Add a REIT to your portfolio. Once you see that money generating returns, once you see dividends depositing into your account, you'll gain confidence. You'll understand why keeping excessive cash isn't the safe play you thought it was. The uncertainty you feel about investing, that's normal. The market always feels uncertain. There's always some crisis, reason to wait. But if you wait for perfect conditions, you'll wait forever. And meanwhile, inflation is steadily eroding your purchasing power. I'm not suggesting you be reckless. I'm suggesting you be rational. Understand that holding too much cash has its own risk, the guaranteed risk of losing purchasing power. Your action steps. Calculate your true emergency fund needs, 3 to 6 months of expenses. Keep that in accessible cash. That's your safety net. Take your excess cash and create a diversified investment plan. Start with whatever amount feels comfortable. Even 10% is a start. Consider consulting with a licensed financial advisor who can look at your specific situation. If this resonates with you, subscribe to the channel for more practical financial content. And seriously, drop a comment telling me your plan. What's one action you're going to take this week? When you write it down publicly, you're more likely to follow through. This channel exists to give you straightforward information about building wealth. Not everyone will agree with every strategy, and that's fine. Your financial situation is unique. But understanding the real cost of holding excessive cash is something everyone should consider. The tools are available. The strategies have long track records. What matters now is that you make informed decisions based on your goals, timeline, and risk tolerance. Your future financial security depends on the decisions you make today, not out of fear, not out of pressure, but out of genuine understanding of how money works. Now let's build something meaningful together.